Welcome back to the Property Investing Roadmap podcast.
An investment in knowledge always pays the best dividends.
My advice is consider the long term, the medium and the now.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
If you're wanting to snap up those opportunities in a competitive market, you need to be on the ball and be ready.
The first part is start early.
What's your goal in investing?
In Season 2, we're shifting gears to accelerate your journey through 9 key steps to financial freedom. From research and strategy to creating a model property portfolio, this is your step-by-step roadmap to building an income from property for life. Today we're covering step 4 of our journey through the 9 key steps to growing an income from property for life. And today we're going to talk about financing your investment properties. Now, while many people focus on finding the right property, how you finance it can be equally as important to your success. Smart financing strategies can help you build a larger property portfolio and maximise your returns. But poor loan structuring can limit your ability to grow a property portfolio or even force unwanted property sales. Now, today we welcome back Caylum Merrick from Season 1. He's a manager of Momentum Wealth's property strategy and finance divisions. He'll be joining us to explore how to finance your investments for optimal growth. Welcome, Caylum.
Thanks, Damien. Good to be here.
Great. Now, look, financing is so important, and obviously you know that in your role as the manager of Momentum Wealth's finance and strategy division. But I want to talk through that a lot today about structuring your loans. But can you just give us some insight? The way you structure your loans, why is it so important, almost as important as the properties that you choose to buy?
Yeah, I guess you want both strategies. So your property purchasing strategy, which identifies the type of asset you're going to target, the areas, that kind of stuff. That needs to also be in sync with the loan strategy, the structuring of it, avoiding cross-collateralisation. You don't want to look to buy another property and try and access equity or refinance for better terms to improve cash flow and find that your structuring of the original portfolio is now not allowing that to happen. So it needs to be in sync.
And look, I think that is the thing that holds most investors back is the ability to get finance. Like, we'd all love to buy lots of properties, but obviously for most people that barrier is the finance, and that's why it's so important to get that financing correctly in place. Now, what are the biggest financing mistakes you see property investors make?
There's a few come to mind. Cross-collateralisation is probably the big one, and no doubt we'll talk about that in a bit more detail shortly. But I think what I've seen pop up recently is clients purchasing in different entities and not fully understanding the borrowing implications of that. Now, of course, there's reasons for why they're doing it, and it might be, tax minimisation or asset protection, but they don't fully understand that sometimes purchasing in an entity can decrease your borrowing capacity. So an example being that a bank will assess negative gearing. When it's an entity, they can't do that, of course. So that difference in borrowing capacity could be the difference in, a quality asset or being limited to a cheaper, lower quality asset. So not understanding that is probably a mistake I see clients jumping into. And
that's a real challenge, of course, because and I own all my properties in trusts, except for my home, for capital gains reasons. But there's some great benefits for particularly people who have their own business to buy properties in trusts and so forth. But you're right, if you're a salary earner and you buy a property in a trust or a company, unlikely a company, but let's say just in a trust, there's negative gearing benefits, but you can't access them on your individual tax return, can you? And then I guess a lot of people may not realise that the banks will also look at it that way and go, well, if it was in your own name, you could get negative gearing benefits and assess that in the cash flow, but not if it's in a trust.
Exactly. And it's not to say that it doesn't end up still being the way the client goes. It's just about making sure they understand all implications. So if you're speaking to the accountant about proposed structures, also speak to your broker about what kind of impact that will have. Are you going to be limited to 1 or 2 lenders through the life of that ownership of the property? Because if so, that'll put you in a box and you'll have unfavourable terms potentially for the life of the loan.
And of course, as we all know, the lenders today, what their policies will be in 12 months' time, let alone 3 months, who knows? But exactly. They change. So can you give us any examples, potentially, other than what we've just discussed, any other examples where you've seen loan structures make a significant difference to an investor's outcomes?
Yeah, I guess it's a simple one, and this is probably more tax related, but it does come back to the product of the loan itself and how the features work. But you'll know about this one, Damien. It's the redraw facilities on investment loans. So a better structure is to have an offset account. And the reason for that is if you've got extra funds, say you've got $50,000 in cash and you want to obviously save on the interest you're paying on that investment loan, if you put that money into the loan account itself and redraw those funds back out, whatever you're using those funds for subsequently may reset the purpose of that loan and reduce your deductibility going forward. And clients don't fully understand that. Quite often mortgage brokers or lenders will just recommend a product based on rate alone. So it's about understanding what are the reasons we're investing in property and what are all the implications involved here. So yeah, it's something that a client isn't necessarily going to be thinking about with all the things involved in property investing that is taking your attention. So making sure that your mortgage broker understands those sorts of things, because it's technically taxation advice, and we're not allowed to give that as mortgage brokers, but we do need to understand the implications.
Yeah, absolutely. And I think that's one of the really important things is mixing your deductible and non-deductible debt. Using offset accounts. If you pay down, as Caylum was saying there, if you pay down, let's say $50,000 off a deductible interest loan, maybe it's on an investment property, you've come into sort of cash windfall, and then you draw that out later to go and buy a car, boat, or take a holiday, you've mixed the purpose of that loan, and that suddenly a proportion of that loan becomes non-deductible for the life of that loan. So whereas if you had an offset account, you're not touching the loan, you could put that money in an offset account and then take it out. It wouldn't affect the deductibility of that entire loan. So but you'd still save the interest. So really important things. But of course, the big thing in investment loans is, of course, we've all got to pay the loan and particularly the interest. And that's why it's so important to be looking at getting the reduction in non-deductible debt. Just as a simple example, if you had to pay $30,000 in home loan interest on your mortgage, and let's say it's a $500,000 loan at 6%, it's $30,000 of interest. Effectively, if you're on the 47% tax rate, you've got to earn over $56,000 pre-tax just to pay after tax, have that $30,000. So it's very painful. And when you look at it, a 6% non-deductible home loan is, if you're in the 47% bracket, is equivalent to well over 11% pre-tax earnings. So if you can get, pretty hard to get 11% it's pre-tax earnings in a what you would call a low-risk environment, which is what paying off your home loan is. So how important when you're structuring loans, obviously, again, we're not giving tax advice, but how do we work with clients to structure their loans so that they can focus where they can, if they've got excess cash, on paying non-deductible debt?
Yeah, the first one is to keep the debt separate. There's no reason to have them all mixed together in one loan account. So we like to cash out equity for various purposes, funding subsequent investments and having those loans separate to one another and, more importantly, separate to that non-deductible debt. So getting that structure correctly, and then understanding when you do have extra cash flow, knowing which loan accounts to actually direct that towards and prioritise paying off. And as you mentioned, it's that non-deductible debt. Yeah.
And do clients often use offset accounts on their home loans? Is that common?
Yeah, of course. I think offset accounts are great. You can use redraw facility against your home loan. That's fine as well, I guess. But offset accounts achieve the same goal in terms of saving interest at the end of the day. And I guess I'm more for remaining liquid, especially if your goal is to grow wealth in property. You need to have cash on hand. And a lot of people just focus on paying off and getting rid of the home loan, which is a good strategy. I like to put it in offset. So you're effectively doing the same thing in terms of interest savings, but you've got that cash available still to be able to use for other opportunities.
And look, I totally agree. The only caveat I'd say on that is everyone's got to assess their personal spending habits, and if you're one of those people who are very disciplined, and then offset accounts are great because you can, if you had 50 or 100,000 or 200,000 in an offset account, that's saving you interest on your home loan. Fantastic, as we said earlier, you return effectively on investment. But some people, they get a bit excited when they see that cash sitting there versus if it was paid off in a redraw. So that's the only thing. You've got to assess your own circumstances. But for the vast majority of people, if you're buying investment property, you're generally going to have some level of discipline anyway. So, yeah, those offset accounts totally make sense, particularly against, firstly, putting the cash into your home loan, because that's that nasty one where it's not deductible. We've got to earn a lot more money pre-tax just to pay that interest bill. So, Caylum, you mentioned earlier cross-collateralisation, and So maybe just give us an example of what does cross-collateralisation mean?
Yeah, it's the pure simple definition is where you have a loan secured by two or more properties. So most common example clients who are cross-collateralised, the reason they find themselves in that situation is they've gone to their bank, they have their home already, they know they've got equity, they want to purchase an investment property. The bank will just give them a loan for a new loan for the full purchase price of that investment property and secure that loan by the home and the new property. So now you've got the new loan secured by two properties. So that's effectively the definition.
And look, it sounds simple, and I know why the lenders do it. The lenders like to keep you sticky. They don't want you to leave. They want to keep you stuck with them for your entire life if possible. That's and they can't blame them. They're in a business to make money. And cross-collateralisation, you walk into the bank and you say, let's say Jane's got a $600,000 home and $200,000 mortgage, and she wants to buy a $400,000 investment property, walks into the bank and says, look, I want to buy an investment property. And the bank says, great, you don't have to do anything. We'll just give you a new loan. We'll secure it against the investment property in the home. And all sounds good in theory. But, of course, next time Jane wants to go and buy a property, she's got to service with that bank, not just the two current loans, the third loan, because that's where it starts to get messy. If you've got all your loans with one bank and you cross-collateralise, and this is where I've seen it gone pear-shaped, and maybe you can talk some examples you've seen as well. If you go to that third property, they're all cross-collateralised, you've got to get valuations on all three properties. Now, in a normal world, when things are going up, everything's fabulous, but I can tell you from my experience, and I'm not cross-collateralising, I remember I had one property that had done particularly well. One had actually gone backwards, over a couple of years because they weren't cross-collateralised. I didn't have that one that went backwards, I didn't have to do anything with, but the one that had gone up, I could use the equity in that. So maybe just talk through how that works when you're cross-collateralised if you want to get additional loans. Yeah,
you're relying on a favourable market for cross-collateralisation to not affect you too much. And, as a property investor, you can't adopt that strategy and hope to succeed. So I guess the better way to do it is to keep the properties separate from one another. So in the example you mentioned for yourself, if one of your properties aren't doing so well at a given point in time, but one is, the good one doesn't have to necessarily balance out the poor performing one and leave you at a balanced position. We could take advantage of the good growth in the other property because it's separate to that one that isn't performing poorly, and you could continue growing your portfolio that way. So keeping the properties separate. And Jane's example here, what we would do with the $600,000 valuation she received is she could take a loan up to 80% of that figure, which is $480K there. She owes $200, so there's $280,000 worth of accessible equity she could potentially get her hands on. And to purchase a $400K property, she could easily rip out 20% of the cost of that, so the deposit, stamp duty, buyer's agent fee, other costs, and then secure the purchase loan, which would only be $320,000 against that new property. So everything's separate to one another, and the deductible debt and non-deductible debt is also separate.
That's a good point, and there is a bit of extra work up front when you're trying to structure your loans separately so that they're not cross-collateralised. And again, I said earlier that I know why the banks do it, because it's easy and they want to keep you all locked into that bank for eternity if they can do that. But from a broker point of view, I don't know why most brokers do it. Now, if a client wants it quick and easy and it's on a short time frame, maybe they've bought the property with very little time to get everything organised, maybe, but in the long run, it's not a great idea because of the reasons you mentioned, Caylum. So it can be unwound, and if you are cross-collateralised, I suggest you go and speak to a good quality broker who understands property investment. They can unwind it and refinance and restructure, and that's important. Look, I've seen it from my own experience over the journey. I've seen people I know who had 10 or 15 properties, all with one lender. The market started going backwards. Another issue that we spoke about when you want to graze equity, it's not only that you sort of get equity out. It's not only that. It's also, let's say you've got 8 properties, for example, and times are tough for whatever reason, and maybe the market's gone against you, and you want to sell one. If it's not cross-collateralised, you sell that one property, maybe you take a hit, but you pay off the loan. If you're cross-collateralised, they generally will revalue your whole portfolio, won't they, Caylum?
Mm-hmm. I've seen that pop up many times over the years, and like we've had clients who are wanting to continue their property journey. They own a few properties already, and the market has sort of hit a bit of a lull, and they can't do anything. They couldn't refinance. The valuations they were receiving with other banks and the existing banks were just not high enough to unwind that structure. I think one of the examples we had, they had to kick in an extra 200 grand cash just to pay down their existing loan limits, just to be able to sell or refinance one of the properties, which they didn't have. So they were also now stuck with that lender, and if that lender hikes their rates or becomes unfavourable, there's nothing they can do about it.
Yeah, and often we know that's what happens. The rates get hiked after a couple of years. They're not in the market, but if you're stuck, you've got no choice. So let's just talk about accessing equity, because my philosophy on this is most people will save a deposit for their first property, and that'll often be their home. But after that, we can hopefully, if we've bought the good quality properties, utilise the equity in those properties. And I'll just give you a simple example. If you buy a home for $700,000 and that grows at 6% annually, well, in 5 years' time, that would be worth about $936,000. So depending on what your original deposit was, you're generally going to have a couple $100,000 of equity that you can put to work into a new property. So how can investors safely access that equity and get into a new property?
Yeah, I think the first thing I would recommend is, if you go to the bank, they're probably going to do the way they've been trained, and that's to cross-collateralise your portfolio. So I would firstly look for a broker that understands property investing, because I've seen brokers out there in the market still cross-collateralise. Like we've talked about earlier, it's the easy way. I call it the lazy way. I'd rather take those extra steps with the client and set up their structure right from the beginning. But yeah. And that's how we do it safely. So applying to the bank, getting the good valuations come through, and setting up a separate loan split for that cashed out equity.
Now, Caylum, I've always used brokers since they've been around. They've been around for probably 20 plus years now, and I know the reasons why I use a broker, and we might cover off on that topic. But if you're choosing a broker, you've made the decision to use a broker and not go to a bank directly, which now 70+% of people do. What should investors be looking for in choosing a mortgage broker?
Yeah, I would understand what type of client you are first and foremost. And if you're a property investor, I'd be wanting to know that broker deals mainly with property investors, because let's say they might specialise in dealing with clients who operate in the first home buyer space, maybe house and land packages, that kind of stuff. If you're a property investor, you're not the typical type of client they're dealing with on a day in, day out basis. So firstly, understand who their main clientele is. If it is property investors like yourself, you're more than likely going to get better outcomes with their knowledge and their expertise in that area. I think another good point is to look at the environment they're working in. Are they a solo operator by themselves, or are they working in a business surrounded by other property professionals? Because a lot of the times that extra knowledge can be leveraged and assist you. And if your broker's got access to that expertise around the office, you're going to benefit from that as a property investor.
Yeah, there's so much information out there, isn't it, as a broker? And I know certainly in your team, they obviously share ideas and expertise. And it's actually, particularly to build a property portfolio, it becomes a bit complex. If you're just buying a home, it's relatively, not always, but sometimes, or certainly simpler than when you get into investment property. And when you start to get into multiple properties, a lot of complexity, particularly with the way lenders assess different things. We mentioned earlier on the podcast, some will assess negative gearing in a trust, a lot won't accept negative gearing in a trust against your own income. So there's lots to consider in choosing a mortgage broker, and certainly I'll give my 2 cents worth on why I've always used brokers since they've really been in existence. I know if I go to a broker who is, firstly of all, choosing, as Caylum said, someone who's an expert in property investors and deals with them regularly, so they're more likely to help you get into that property portfolio. But importantly, they got a choice of so many different lenders and so many different products. The 30, 40 different lenders, and they've got a lot of those lenders have many, many products as well. It's like if you go to a bank, it's like going into a McDonald's and the only thing they've got on the menu is a Big Mac. That's all they got. Is if you go to a broker, you're going to get the full suite of options. And I remember the best advice I got early on was, Damian, a bank is not your friend. Don't ever believe that. They're not your friend. They're not there to look after you. They're there to make money out of you. Fair enough. That's their business. But at the end of the day, if you don't meet their criteria, they're not going to give you a loan. They're not going to be able to pull strings anymore. Those days have gone. So I just think it's anybody who's looking to build a property investment portfolio, I just totally makes sense and to be using a broker. I don't know why anyone wouldn't, particularly when they can get access to pretty much the same deals and rates that you can going to a bank direct. So and what sort of information would investors need to prepare before meeting a broker? Anything particular?
I think, if you're a property investor, you've obviously got some goals that you've thought about, or maybe that's a step you need to take before taking the plunge. But knowing what those are and being able to communicate that clearly up front, because you don't want any broker's short-term loan recommendations to go against what we're trying to achieve over the long term, and that can happen from time to time. The other thing as well, just be ready and willing to provide all the info and documentation needed up front quickly, because I know it's a pain. Most clients roll their eyes every time we ask for extra documents or need the documents and information to go through the process, but the bank needs it. We have to get it. And, if you want to snap up those opportunities in a competitive market, you need to be on the ball and be ready.
Caylum, what are a couple of things that investors can do or should be doing to increase their borrowing capacity? And maybe what are some of the things they shouldn't do that actually limit their borrowing capacity?
Yeah, well, if you own investment properties, make sure you're receiving above market rents where you can. You don't want to be under renting the property, because that's income that's being assessed for future loan applications. So that's probably one thing, staying on top of maintenance, making sure you're achieving the best rent you can on your investments. Another is, closing unused facilities. If you've got credit cards, reducing credit card limits can sometimes help bump up your borrowing capacity. We've had clients who have had car loans, lots of them, and whatnot. Those shorter term financing options can attract quite high monthly payments. So sometimes being prepared to pay those out can improve your capacity as well. In terms of you don't want your credit score as well to be the reason why you can't obtain finance. So just making sure you're not, making a ton of inquiries and not going ahead with them, because banks do look at that. Always repaying your debts on time. They've got visibility to that now through the credit report system, rather than asking for your bank statements to see the missed repayments. So they'll be able to see it regardless. So staying on top of your finances, making sure you're just doing the simple things.
The three worst things that really impact your borrowing capacity, in my opinion, are kids, cars and cards. And as much as we all love our children, and Caylum, you're a recent father, but the next child you have is going to impact your borrowing capacity, don't you? So that's a conversation with your partner to have about whether or not we should have a child or buy another investment property. But no, when you have a child, that they put an expense on your to your spending each year. So that limits your borrowing capacity, but obviously that's a personal choice. But certainly from a pure economic choice, credit cards. You might have, like me, I've got some credit cards, and I've got on some of my cards very big limits, but the lenders don't look at the fact that apart from a ability to make payments, they look at make sure I pay them each month or make payments. But the fact that is, if I've got a $100,000 credit card, they assume that I'm going to spend quite a chunk of that, 3% each month, even though I pay it off in full. Makes no sense to me, but that's how they do it. Credit card limits can really impact your ability to borrow, so maybe you can reduce them. And look, there's nothing to stop you. 2 days after the loan settles, you can go back and apply for an increased credit card limit, but just that's how the system works. On the day the loan is approved, you need to have potentially a much lower credit card limit. As I said, even if you're paying it off in full each month, it doesn't matter. It's about the limit. And as Caylum mentioned, the cars, great to get a car and you might go and borrow some money. But because on a car loan, you're paying off not only interest, you're paying quite a chunk of principal because they go down in value. That all goes into your cash flow and assessment of how much you can afford. So, and I'm sure sometimes, Caylum, you refinance those car loans as part of refinancing home loans. As much as we don't want to make that into a longer term debt, sometimes that's the only way we can people can service those loans. So anything else in that regard, anything else that stands out, what investors should be doing or should not be doing if they want to continue to maximise their borrowing capacity?
Yeah, another one is probably being prepared to use lenders you may have never heard of before. Every bank has a different policy. Your borrowing capacity will be different between every single lender out there. So some will give you more money. Maybe the rate might be slightly higher, or maybe their online facilities aren't as good, or they don't come with all the bells and whistles. But at the end of the day, if they're willing to lend you money and that they're decent enough, and the brokers should know because we deal with them on a regular basis. That could be a good strategy as well, because some clients are sort of, I just want to go to this bank, or I've only been with them, I don't want to go to anyone else. You just got to look at what your priorities are at the end of the day. Another as well is extending loan terms back out to the original 30 years can be quite helpful. Obviously, you're going to pay more interest on that facility over time. But again, what's the end goal here? Is it to obtain more funds to continue buying quality assets, or is it just to try and reduce your interest costs?
I guess the other thing with that, though, even though the term of the loan might be 30 years, and that's what the minimum repayment you make, you can pay it off quickly, of course. If you've got a variable loan, which most loans are in Australia, or even if they're fixed, you can fix part of the loan and have some variable. You have that flexibility, don't you, to make extra payments? Yeah,
absolutely. And that's what we'll let our clients know as well. Even if they've cashed out equity to clear out one of those car loans, we'll figure out, all right, to get rid of this in 5 years, you'd need to pay X. So we let them know that. They set up that direct debit, and it's gone. But it's been assessed as though it's been paid over 30 years, and that's a big difference in borrowing capacity.
Now, reviewing your loans, what's your thoughts on when people should review their loans? How regularly should they be talking to their broker to look at their loans and whether they need to do anything or whether it's worth doing anything with their loans?
Yeah, you made the comment before, banks are not your friend, so they're not going to give you a call out of the blue and offer you a discount for no reason. So they're probably going to do the opposite in a sneaky way. So at least once a year, I would say you want to stay on top of your finances if you're in a period of inactivity in your portfolio journey. But another time is if you're planning on potentially going again and acquiring another property, or you've had some significant changes or looking to make some changes, that's probably a good time to have a look at the numbers as well.
And so, Caylum, thank you for today. What's your top piece of advice for investors about financing their properties?
We've touched on this a couple of times throughout the conversation today. I think the biggest thing for me is engaging a broker who knows what they're doing. There are a lot of brokers out there, and you made the comment, we're almost at 80% of all loans written in Australia are done through the mortgage broking channel. Clients have figured that out now, increasingly figuring that out, and that number's going to continue to grow. It is by far the best way to do it, but you want to make sure you're aligned with the right person. If you're a property investor, get yourself in front of someone who understands that, who knows not to cross-collateralise portfolios, and has a good, sound understanding of the property market as well.
Yep. Good on you, Caylum. Look, whether you're buying your first investment property or you're scaling up to your fifth, remember, it's not just about what you buy, but how you finance it that drives long-term success. Structure your loan strategically, and this will help open the door to real sustainable growth and, importantly, help you build a larger property portfolio. Thanks again, Caylum, for your valuable insights today. Next up, we're on to step 5, where I'll dive into the model portfolio strategy. You won't want to miss it. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note that the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied on for investment or financial decisions. Always seek professional advice before deciding whether to invest.